following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we are talking about money. I'm here with Chris. I'm here with Al. We've got a lot to talk about today. You know, they came out with the CPI numbers, the PPI numbers. They're the highest they've been in 40 years. We have to go back to the 1980s and the 1970s to see inflation numbers that have been this high. So what in the world is going on? There are people that think we are headed for a recession because the yield curve's inverted. There's people think that we're going into a full-blown inflation period of time. We're going to talk about that today because it's an important issue. It's an important topic. And we want to separate it into understanding that there's a cost or supply push type of inflation, a demand pull. And I sometimes get in backwards. That's okay.
Don't we all?
A demand pull is where you have a limited supply. You've got more money to buy things than you've got supply. That's what we're seeing right now. If you look at it, new cars, the production slowed down because there's a lack of chips. The chip factories are either shut down or they're full capacity. So the number of new cars being manufactured was lower. People began to look for cars, and they began to bid up the price of used cars. I have a friend who leases his car every 3 years, leases a Mercedes, changes every 3 years. He had a call from the dealer that said, we need to talk about a new car. He said, it's 9 months before my lease is up. The car dealer said, we will give you $5,000 over your residual value to bring it in. We will actually give you a check for $5,000. So, of course, he went with the new car. We're seeing that. Used car prices up above, even in some cases, almost above new car prices. That's a demand pull kind of inflation. Cost push is where you have commodities and labor prices pushing up prices. What we're seeing today is a combination, actually, of the two. And especially the demand pull. Some economists think that we're at a peak and that we'll start to see things coming down. And we've seen some examples of that.
Oh, Mike, I was going to throw another thing out there, is that I was talking to my daughter who's taking an econometrics class at college. She's home, and I said, well, what are you guys studying? She says, well, we're trying to prove what's something called bottleneck inflation, which we're also seeing is the supply chain being bottlenecked. I think, like Sesame Street, that's our word of the day is bottleneck inflation.
Yeah, it could be. I mean, we're seeing the supply chain really slow down. Mm-hmm. And in theory, if that is the cause of inflation, as that straightens itself out, we should start to see inflation decline again. But Chris, you've been looking at it in a different way.
Yeah, I've been looking at it in a number of different ways. And I guess I'm not quite as optimistic as you, Mike. We've seen, the CPI increase for the last 6 months. I believe back in October, it was in 5-6%. And then in the recent numbers, it's up over 8.6. And we have all these analysts, banks, even you, Mike, you talk about how this is probably the peak. But to me, I'm seeing inflation accelerate when I go fill up the car, or when I go out to eat. Everything's getting more and more expensive, and so to say that it's slowing down, it's harder for me to believe at this point.
But if it really is a demand pull kind of inflation, and the supply chain it's a bottleneck inflation, as Al mentioned, when the supply chain gets straightened away, and if you look at what's happening with used cars, you mentioned the other day about CarMax.
Yeah, CarMax is actually their latest numbers came out, and they're actually losing money. They didn't make as much off the used cars as they had anticipated, and that analysts had anticipated them making. And so we're starting to see that, at least in the used car market, it looks like it's starting to slow down just a little bit. At least from what I've seen and from what some of these numbers are pointing out.
But that's on the car side, and that's the supply chain. But there's another part of it, and that's something you were talking about the other day, Al, about commodities. And you mentioned soybeans.
Soybeans, yeah, the lovely little soybean. Soybeans have gone up 12% this year. And there's a lot of reasons for that. And it's not just because of the war in Ukraine. I know that Ukraine supplies 12% of the world's grain, but that's not the reason why we're seeing soybean prices go up. One of the big reasons that's not being talked about is the La Nina drought that's going on, that's driving prices of all grains up.
So talk about that.
Well, so let's break this down a little bit. So the demand for soybean meal, which is used for farm animals, is up 20%. The demand for soybean oil, which is used a lot in cooking and industrial, is up 40%. And now you combine that with renewable energies that they're using, and that is driving this price way up. So it has nothing to do with the war in Ukraine. Now let's throw this to the mix, Mike. I know you know a lot about China, but let me see if you know this statistic. China produces and consumes half of the world's pork. You say, Al, what does pork have to do with this? Well, they had a huge swine flu some years back, decimated their pork population. Now they're trying to rebuild that population. What are they buying? Soy meal. And they're buying it in boatloads to increase that population back. So that's driving the price for those commodities, that commodity up through the roof.
And that affects other commodities as well, food prices.
Yes, food prices directly related because soy goes into everything. It's going into, you look at any product you buy, especially any processed food, anything anything on the shelf, and you'll see that there's a byproduct of soy in that food. And so it does affect everything.
And I do remember not when Trump was president that they put tariffs on soybeans, and that shifted the market as well. It shifted the Chinese consumption to a lot of South American soy. Mm-hmm. Mm-hmm. But it's a real issue.
It is.
So as we look at this whole thing, we've painted a pretty negative picture, but there's a positive picture too. You were talking about Fastenal, for example.
Yeah, if you guys out there don't know what Fastenal is, Fastenal, you'll see this stores around Seattle, Tacoma. They're an industrial supplier of thousands of different industrial products, and they're kind of a barometer for how the industrial economy is performing. And so because the reason why is that they're one of the first companies to release their quarterly earnings. So I was reading an article from Al Root from Barron's about that. He said that Fastenal's a good real-time look at the demand. Fastenal's a good real-time look at the state of demand, even though it's tight right now. So conditions have stabilized because customers are better able to plan and navigate challenges. And so the CEO, that was the CEO of Fastenal, saying that, and they're seeing that their products are being bought and their demand is strong. So, and they're not seeing necessarily inflation that in their products, but they do have pricing power over their products. So I don't know. One thing I don't mention is whether they raised prices or not. I don't know that.
You hear a lot of people that are talking about raising prices. That I remember back to the time of the 1960s and 70s, and prices were being raised. It became almost what's the new price this month? Yeah,
and one other thing I read. This is not related to Fastenal, but that about airline seats are up, flights are up, prices 30. This doesn't make sense to me, Mike. Maybe you can understand this, but domestically they're up. They're going up 38%, and internationally up 28%. I don't understand that, but I read that just this morning. And so because of with COVID, they lowered prices to get people to fly, and now they're like, hey, we're out of this, and so they're raising prices, and they're seeing demand go up too.
I know that for my granddaughter's graduation coming up in June, we booked tickets to go, and on a Friday, they were completely sold out. There were no seats available, not economy, not first class, nothing. We got 2 tickets on first class for Thursday. They were the last 2 seats available that day. All the economy was gone. Everything else first class was gone. And on Sunday, we had a few options to come back. And on Saturday, only a few options. So, I mean, we're seeing demand pick up, and we're seeing shortage of supply.
Yep.
And that lays the groundwork for demand pull.
That bottleneck again.
The bottleneck inflation. I love that word. I love that. So we are going to be coming to a commercial break. We're going to return to this and talk about what's going on, because the Fed has announced they are going to begin to deal with this. So we're going to talk about the Fed in the next segment. Don't go away. We've got a whole lot more to talk about. We've got to talk about the impact on the stock market. We've got to talk about where things are going. Don't go away. We've got so much more to cover. So I'm here with Chris and Al. We're started talking about inflation, the cause of inflation, what's going on right now. It's a major subject. It's a major deal of what's going on. And right now, the Fed has announced they're going to deleverage. They have $9 trillion of assets on their books. They're going to begin to deleverage. They're going to begin to deleverage $1.1 trillion a year. That's very significant. And you think about the Fed. You think about the Fed as being independent. It's supposed to be independent. They're supposed to make these decisions based on controlling inflation and unemployment. And they're supposed to be the bank of last resort, the last lender. But you know what? I can remember not long ago a story about during the 1960s and 1970s, something that I didn't hear about until decades later, but I heard that William McChesney Martin, who had been the chairman of the Fed, he was appointed by Truman, he was reappointed by Eisenhower, reappointed by Kennedy, and reappointed by Johnson. Martin was invited by Lyndon Johnson to his ranch. And as they began to discuss, Johnson suddenly grabbed him by the shirt and shoved him up against the wall and said, "You gotta lower interest rates. We've got a war in Vietnam going on. You gotta lower interest rates so I can finance the war." And you know what happened? He lowered interest rates. We're going to talk about some other stories like that as well as we go along. That was the 1960s, the 1970s. You know, it wasn't an isolated incident. But that's where the Fed has gone through these periods of time. When you look at it, Martin, appointed by Truman, Eisenhower, Kennedy, Johnson, he was served during the first term of Nixon. But when Nixon was coming up for re-election in 1972, he was concerned about winning the election and would start it into a recession. Martin had already begun to raise interest rates during Nixon's term to deal with recession and inflation. But Nixon was concerned if we plunged into a recession caused by the Fed raising interest rates, that his chances for being elected would go down. So Nixon decided to appoint Arthur Burns as chairman of the Fed. And guess what? What Burns did? Burns lowered interest rates.
And what happened?
And inflation took off. And it was further complicated by the fact of backroom negotiations over oil prices and arms, and OPEC was formed, and oil prices went up, which further accelerated inflation. Burns never dealt with that. It would be Volcker that would finally deal with it. Which brings me to the story about Volcker, too, because Volcker is raising interest rates to deal with stagflation. By that time, you have a recession, you have inflation going on both at the same time, and Volcker is dealing with only one of those things. He's dealing with inflation. Ronald Reagan, calls him into the Oval Office and says, "We need to deal with interest rates. You need to drop interest rates." Paul Volcker said, "Thank you, Mr. President," turned around and walked out and continued to raise interest rates. To my knowledge, that's the only Fed chairman that hasn't yielded to political pressure. But then we have to talk about what's happened more recently. Chris, you looked at that.
I did. And what astounded me, and it's something that I'm surprised that more people are not talking about, and that's where the balance sheet of the Fed is right now. Never in history has the Fed had the kind of balance that it does right now. We're currently at $9 trillion. And I know when you throw numbers out like that, it's kind of hard to reference just because they're so big. It's hard to really grasp your mind around. But
we got there in a reasonable way. You looked at that.
Well, we got there from 2008, right? This didn't start in 2020 like a lot of people think it did, right? We started building that balance sheet after 2008 crisis when we started putting a ton of money into the economy from the 2008 recession.
And we continued in 2020.
Well, what's interesting is prior to 2008, I just mentioned that $9 trillion number. I'm looking at the chart right now of the balance sheet over since 2007, and prior to 2008, the Fed only had less than $1 trillion. It looks like 900 billion. So in the matter of 12 years, we went from under 1 trillion to over 9. And now we're dealing with this problem where the Fed has never had a balance this large before, and we're trying to unwind it because we see inflation where it's at, right? In the last 6 months, it's gone up some 3%. We have a huge balance sheet. Interest rates are historically low, and now there's this balancing act that needs to take place that's never happened before. And Mike, this is something, and you too, Al, this is something I'd want you guys to speak to. The last time the Fed tried to offload some of its balance sheet was in the year 17. And at that time, we were only dealing with about $4 trillion. And so to me, that's interesting. In just a few years, we had gone from 4 to 9, which is, doubling of the balance sheet. And they still weren't able to get rid of it at that point. And even in 2017, that was historically high.
And they began to unwind in 2017 and 2018. Mm-hmm. The idea was, and they did unwind. They unwound $800 billion in those 2 years. And as they got to the...
Why did it stop? I mean, you're at $4 trillion, right? That's huge.
And they raised rates, and they started raising. Remember, they raised rates in 2015, right? They started moving 0.5%, and then they backed off again.
And that was Yellen, wasn't it?
After yes, it was Janet Yellen. Yes.
So what happened? So if you look at what happened in 2019, 2018, the market was having a very, very good time. It was a very good market. It was up almost 20%. And then it began to fade. Mm-hmm. Yeah. And by the end of the year, it had lost everything it had gained in the first 3 quarters. During that period of time, during that year, Trump had appointed Jerome Powell as Fed chair. And on Christmas Eve, the market took one of the largest drops it's ever taken, because the reason for that drop was that Trump was considering firing Powell. He wanted to fire Powell because Powell was not stopping the deleveraging of the balance sheet.
Well, that sounds a lot like the history that you'd mentioned a couple minutes ago.
I believe it is. At the time, you can't see what was going on. We didn't know what was going on. drawing conclusions from what happened. The Fed quit deleveraging.
Yeah.
And Jerome Powell kept his job.
Well, it's funny because I was looking at 2001, right? Again, I mean, the 1999 recession, right? The 2000, 2003, 4 recession, but the bubble. And I was, saying that this time is different, but the irony is it really wasn't much different because, Mike, you remember there was something called Y2K, right? And so what happened was the markets were doing fine, everything was doing fine, but the Fed had this impending doom of Y2K that everything, when that bell rang, right, when the ball dropped in New York City, that everything was going to go to HE double hockey sticks in a handbasket, right?
Right.
But it didn't happen. But the Fed decided to pump a ton of money. They increased the money supply by 22%. And seeing that, right? Then later in the year in 2000, realizing that nothing's going to happen, what did Mr. Greenspan do? He stuck a little pin into the bubble and burst it, and then all the .coms came crashing down. But that's not the only reason that happened too, because at the time, you remember the Super Bowls of 1999. Every commercial was a .com commercial, and I was reading this morning that these companies were getting tens of millions of dollars. The banks were using it was a classic pump and dump. 90% of the money that the .coms were getting were going to advertising.
And I remember those times because .coms were so popular that there was a machine shop that came out. It had nothing to do with the internet. But as the IPO came out, they added .com to the end of the name, and it got a 30 or 40 or 50% premium to what it would have gotten as just a machine shop.
But things that were different then is that interest rates were not zero like they are today, right? Interest rates were, you could get an annuity paying 7% back then. So it wasn't like there wasn't alternatives to investing. You could put your safe money somewhere and get a return on it. Where today you couldn't do that.
And I did a little bit of research, in the mid 90s to late 90s, right before that crash of 2000, and I was looking at interest rates. And when you look at the charts over that 8-period time, interest rates were pretty constant, around 5%. Obviously they go up and down, but it was pretty constant. And then when we look closer to, let me see here, right at 99, looks like rates started to dip a little bit, right into the 4%. And then right before the crash, we notice, what happens? Interest rates rise, right? And then what we're seeing is we're also seeing inflation. It was pretty constant at 1.5% to 2%. And so what I've noticed through some of my research is that when rates rise too quickly, and meanwhile inflation is pretty stagnant, we tend to see an adverse response from the market, at least from a S&P standpoint. And what proceeded to happen over 2000? Well, it crashed.
Yeah, but there was a lot of fluff in the market. A lot, the .coms were just a crazy time. So, but we want to bring it to what's happening now. We've talked about the history. Let's bring it to what's happening in 2022. And we are coming to a commercial break. So when we come back to the commercial break, we're really going to be talking about what's happening. What is the Fed doing? What's going on in the economy? So don't go away. This is a very big subject, and you want to hear the rest of the story. Talking about inflation, we're talking about a real change in what's about to happen, because the Fed has announced not only are they raising interest rates, but they're going to deleverage the balance sheet by $1.1 trillion per year. What does that mean, and what's going to happen because of that? Is it, in fact, political? I believe it probably is. The whole idea of deleveraging is disinflationary. We're going to talk about that in a minute. But first, let's talk about what happens with the Fed. The Fed is often accused of printing money. What happens when you have a Fed that prints money is that the Fed goes into the market and buys bonds. Buys treasury bonds. They've been buying corporate bonds. They've been buying whatever might happen to be out there.
A lot of mortgage bonds, too.
A lot of moving parts, but $9 trillion worth. Now, if you and I go out and buy a bond, We have to have the money in the checking account or in a brokerage account, and the money transfers off our balance sheet onto whoever the seller is. But the Fed has no balance, has no checking account. They don't have a brokerage account. They just simply go out, create money, and buy a bond and make a mark in somebody's checking account or brokerage account and deposit money there that never existed before. That's why they say the Fed is printing money. And what that does, suppose that money goes into a bank. So, Al, you talked about what happens when you deposit $1,000 into a bank. What happens?
It gets relent and relent again, and so that $1, $1,000 can actually end up being like $3,000, depending on how many times the bank lends that money, because they don't have to hold that whole $1,000 in the bank deposit. They only have to hold a certain amount. So they can relend that money over and over again. So it creates this, what they call the velocity of this money being turned over and being relent in the economy.
Sure. They only have to hold 5% in cash, so they can loan $995.
Now, the Fed can change the reserve. They do have the ability to change the reserve requirements, too.
Yeah.
If they want to stop the lending, they can say, hey, you got to hold 10% or 15%.
But they simply, when they make the loan, they move that money into somebody else's account. They have to hold 5% of that. And that money then gets spent somewhere else. It's the old saying of the butcher pays the baker, pays the candlestick maker. Mm-hmm. It's a multiplier effect. So when the Fed is printing money, when they're printing, in this case, $9 trillion, the effect is not $9 trillion flowing into the economy. It's more like $25 trillion flowing into the economy. So what happens on the reverse side? So think about this. Think about the political side of this. You have a president and you have midterm elections coming up. And you have inflation that's hitting the highest level it's hit in 40 years. You have low unemployment, but you have what's called the misery index. The misery index is the unemployment rate plus inflation. And for it to be a good time for the controlling political party, it has to be in the 6 or 7% range. Right now, with 8.5% inflation and 4% unemployment, we're talking 12%. So what can you do? In other times when you needed to stimulate the economy, when it was George Bush or when it was Obama, they found ways to, or in the first term of President Trump, they found ways to pump money into the economy to stimulate. Now we're dealing with a completely opposite problem. We're dealing with inflation. So what can you do? You can unprint money. Just reverse the process of what you did to print money by taking money out of the economy. And we don't know what's gone on or what the decisions have been, but we can sure guess at what they might have been, is that they want to control inflation. And one of the ways to do that is to unprint money, take 1 trillion out of the market. So what happens when you do that? Chris, you looked at that.
Taking money out of the economy.
Yeah.
And it's very concerning because, and then here's a quote from J.P. Morgan CEO Jamie Dimon. He said, this is in no way traditional Fed tightening, and there's no models that can even remotely give us the answers. And so, like I had mentioned earlier, we're at a place where there's $9 trillion on the balance sheet. We've never had this high of balance sheet. We've never been $30 trillion in debt. GDP is 125% of that debt right now. We already have interest rates extremely low. So it's like, what are you supposed to do from that standpoint? Yes, unemployment's low. Yes, GDP is growing. Yes, there's a lot of positives in the market, but we have to unwind this now, and we have to be very delicate in the way that we do it.
And it's never been done before.
Yeah, well, I mean, Mike,
2017, 2018,
and that was only $800 billion over those 2 years. And then we looked in the market. The market was pretty healthy for the most part. But when you look 18 to 24 months out, that's typically when the market responds to these rate hikes. And and we saw that in late 2018. This is what was happening to Trump throughout 18. It was good, and then fourth quarter things started to get bad. He put pressure on our Fed chairman Powell, and then all of a sudden, there's no more cutting back on spending. We're keeping it pretty stagnant, and I think we're paying for those mistakes right now. Is really what I'm trying to get at. Is we're paying for the mistakes of letting this balance get too high for so long.
Well, that's what Larry Summers said, right, in his latest New Yorker article, is that he predicted this a long time ago, that the Fed, we're going to be hitting hyperinflation and unemployment, and these things are down the pike in the next couple of years.
So, I mean, the real question is out there, and I have a different take on the whole thing. I'm certainly not a nationally known economist, but if you look at what's going on, if you look at what happens, if the Fed is on printing money and taking money out of the economy, it's going to be deflationary. If pumping money into the economy at a full growing economy is inflationary, if you're taking money out of the economy, you're taking money away from the candlestick maker. You're taking money away from the butcher.
The butcher and the baker.
I was trying to reverse the order, but I couldn't get it. I can't say the alphabet backwards. Count from 100 back to 0. Anyway, you're taking money out of their pocket. You're taking demand away. And the potential is it sends us into a recession. But I want to come back to the question that you raised, Chris, about whether it was a mistake. Because we built this during 2008 and 2020, right, Al?
Yeah. I don't think it was a mistake. I think the Fed had to do what they did in 2008, and they had to do what they did in 2020. I don't know after that if continuing was necessary, but that's where we are. So
yeah. Well, you looked at the 1870s, right?
1870s?
1870s.
I didn't look at the 1870s.
We had a very difficult time in the 1870s because at that time we did not have a central bank. And nobody bailed us out.
Yes, that was that was actually 1893. It was a lot like 2008. You had this company of these called the Baring Brothers, which is almost like Lehman Brothers, and they basically were leveraged and crashed the economy. And it was J.P. Morgan that had to come in and bail them out. And then the Fed was created some 1913, some 20-something years later, and so that's where we are today.
But by not bailing us out, we had really high unemployment for a long time. We had a recession every other year.
Oh yeah, the I guess what the economists would call the externalities of depression, recession is. I mean, you just look at the suicide rate and all the other things, just like what's happened with COVID, and it's really bad for the economy. It's really bad long term.
So we got here. There was a reason to get to where we were.
Yeah, and saving the economy in 2008 by pumping in the stimulus, that wasn't the bad move at all. That was the right thing to do, saving the companies. Otherwise, things could have gotten a lot worse. The problem is between 2010 and 2015, we had 3 years of double-digit growth in the S&P 500 and 1 year of single. They were all positive. Things were back on track. Things were going well, right? And Janet Yellen made the right call in 2015 by starting to raise rates again and offload the balance sheet. We were on the right track. We were doing the right things. You can't enjoy just printing money forever, right? Because eventually you have to pay for it. And finally, when we're starting to do the right thing, something mysteriously happens. We stop all of a sudden. We stop offloading it. We stop doing the right thing.
Election is coming up. So, I mean, you have to figure into the politics of the whole thing. And,
And we talk about the Trump tax cuts and the effect of that's just putting more money into the economy. Was it a good thing or a bad thing? We're not here to debate that. Yeah. We're just debating the empirical data that is putting more money out into the economy. And so when you have a Fed printing money and then you have tax cuts and more money going out, is that a good thing?
Yeah. It is what it is. And they don't call us up and say, Mike or Chris or Al, what do you think we should do? So our whole function is to deal with the situation as we find it,
That's right.
and to do well for our clients by dealing with the situation as we find it.
Right.
And we're going to wrap this up in the next segment because we're going to talk about what we do about this whole thing in the last segment. So don't go away. We'll be right back after this commercial break and try to wrap this up and make sense of all that's going on. We want to bring this all together. And it reminds me of a study that I read that came out this week, a J.D. Power study. They studied the advice the clients were getting from their financial advisor. And what they found is only 14% said that they are receiving advice from their primary financial advisor. They're looking at teams, and the primary financial advisor is a junior advisor who's giving the advice. We don't have junior advisors at Adams Financial Concepts, just to let you know. Very few, even the highest net worth people, according to J.D. Power, get optimal advice. Very few get optimal advice, according to what J.D. Power feels is optimal advice. And yet they found that 51% of people that were with full service brokerage accounts, full service advisors, said they got comprehensive advice. But J.D. Power said that has to mean that they have low expectations, because only 26% really received comprehensive advice, not optimal advice. And 76% of people said that they were happy enough that they weren't even considering changing financial advisors this year. I mean, that's the situation. People are not receiving the advice, they're not receiving optimal advice, and they're not receiving it from the primary broker. I think that's something that is, in this case, where we're dealing with a situation with high inflation and the Fed about to deal with it. Clients need to be hearing the right advice and optimal advice. Al, you were at a conference this week.
I was on a conference on energy and power.
And tell us.
Well, there was a guy, an interesting guy. His name is John Ashford. I've met him before. He runs this group in Washington. I think it's in Washington. I'm not sure where it is, but the Hawthorne Group, and they're a public affairs and public relations firm. And they basically just try to break down public sentiment and where politics are going. They don't take a side here. And one thing he was pretty clear on was that he believes strongly that Biden's going to get his bill passed, his big Build Back Better by September 30th before they change Congress. He thinks that Manchin will come around because there was something about electric vehicles that Manchin didn't like, and he believes strongly that that's going to be nixed in the plan, and that Manchin will come around and sign this plan, and they'll get that 1.9 trillion. What's that going to do to the economy, and with inflation and everything? Is it going to be a push with the unwinding of the balance sheet, and that I don't know.
But it's sitting out there.
It is.
And it has to be dealt with.
It is.
Inflation has to be dealt with. And yet we've gone through this inflationary period before. 1960s, 1970s, we went through a period of high inflation. And during that time, the stock market in 1966 hit its high at 1,000. It dropped 20%, then it rose back to 1,000, then it dropped 30%, rose back to 1,000, dropped 40%, then got back to 1,000, then dropped 20% before finally in August 82, 16 years later, finally breaking out and going. Chris, you looked at that, and you looked at what happened during that period of time.
I did. And one of the big things that stuck out to me was the 13.29% inflation rate at that time. People were freaking out. In fact, we see a lot of similarities to today with inflation where it's at and at that time. And so one of the other things was interest rates were at 19% as well during this time. Could you imagine paying 20% interest almost on federal debt. I mean, that's absolutely that's something that I could never comprehend. And so, what I wanted to bring it back to, Mike, is you talked about your advisor, giving you good advice, right? And so, right now, when clients come to us and they're asking for good advice, what do we do? Where do we put our money? For the last 10 years, you've been able to say, hey, you can just invest in the S&P 500. It's going up. It's kind of a gravy train right now, but that's ending. And so the last time we had inflation similar to where we're at is the 80s, like you had just talked about. So when inflation was at 13%, and in the 80s, you had mentioned there was a number of drops, 40% drops. Indexing your money was not the way to go, and that's what a lot of advisors would have mentioned back then. So it's like, what do you do with your money? Where do you put it? Where do you go? And Mike, you talk a lot about this, but it's the stock pickers market. In the 80s, we had the Nifty 50. We had companies like Coca-Cola. We had companies like Anheuser-Busch, General Electric, Gillette, IBM, McDonald's, Merck, PepsiCo, Pfizer. I mean, the list goes on. And these were all products of seemingly bad markets.
They were. And they were the Nifty 50 because it was a very small number of stocks. We've seen some of the similar kind of things going on with the FANG stocks, but yet they are not inflation proof. We're at a point where we want to deal with being in the right place at the right time. And the point you raise is really valid. We want our clients to deal directly with you, with Al, and to know specifically that the advice they're getting is the best advice, optimal advice. We don't classify our clients. I've talked once before about the classification that a lot of companies will do, that if you have a minimum of $4 million, you're an A-plus client. If you have $2 million in assets at the firm and can get the $4 million, by adding money, you're an A client. And if you can get to $4 million or to $2 million by adding money to your account, you're a B client. And if you can't get to 2 or 4 million, you're a C account. And think about it. Even the A plus people, very few are getting optimal advice.
What's that C guy getting?
Yeah.
The bottom of your shoes? I don't know what it is. I don't know.
And at a time like this, you're going to want optimal advice.
Yeah.
It's going to be choppy.
It's going to be a choppy time. And it doesn't mean that everything's always going to work in the right way. We've seen that over the past year at AOC, but we're optimistic. We think that we're clients in the right place at the right time. To emerge from this, and this could be going on for another decade.
$9 trillion and $1 trillion a year trying to write that. I mean, that's at least 9-10 years right there. I mean, it's hard not to get worried.
From 1961 to 1979, the dollar lost 70% of its purchasing power. What you could buy for $1 in 1961 cost you $3 in 1979. It took the S&P 32 years to recover in real terms what the CPI did. From 1961, the Standard & Poor's didn't catch up until 1993.
Ironically, some stock pickers had their best years during those years. I mean,
they sure did.
John Neff in 1974, which is a terrible year, was up 123%. Wow.
Yep.
I mean, so it's a stock picker's market right now.
It is a stock picker's market, and that's what we do. That's what we do for our clients. Anyway, we're going to wrap up this program. You've been listening to one of the big issues. It's confronting us today. It's going to continue to confront us next month, and the month after that, and the year after that, and the year after that. So being in the right place at the right time is going to be really important. It was in the 1960s and the 1970s. We see the same issues coming up in the 2020s and the 2030s. We think it can be a very, very good time. and we think it's important for people to be in the right place at the right time. Anyway, if you miss any of this program, you'll find it on YouTube within a few days. You'll find it on our website. It's a really important topic, and I keep saying that over and over again. It's something that the three of us have spent a lot of time looking at and going through, and you're getting some of the very best. So that wraps us up for today.